Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 15th of May 2020, and tomorrow we shall be publishing our gold and silver weekly update. And don't miss it, as there's been quite a lot of movement in the precious metal markets this week. And we envisage quite a lot more next week too. Now, we've given some guidance to this in that yesterday we published a video entitled Gold reaches all-time high in sterling and has further to go, and it has. On Wednesday, markets fall, gold rises as China tensions increase, both still pertinent today. On Tuesday, more stimulus ahead, banks running out of options, which we also claim is very pertinent today, even with additional announcements, particularly from the European Central Bank. And on Monday, the reasons advisors are now recommending gold as an investment, which should now come as no surprise. The investment community, or the advisory community, has always been slow in recommending gold, mainly because it provides little yield, but also because very few investment advisors actually get paid, unless they're paid on an hourly basis, for recommending these sorts of investments. Whereas by recommending various forms of funds, their income often is much higher. Now today we've seen both gold and silver rise yet again, but this time even more sharply than it has during the course of the week. But first, let's take a look at a Reuters report published this morning, and then a Bloomberg report published just a short time ago. Reuters article dated May 15th, 9:34 a.m. Daily briefing. Friday stocks bounce to cap week of gloom. How quickly things change in markets. After the euphoria of April, world stocks are on track for their biggest weekly loss since mid-March. The dollar has gained 0.5% this week against a basket of currencies. Gold has risen 2% and treasury yields are down 6 basis points. But on the last day of the week, the mood has swung around again, with MSCI's global index up 0.3%. European markets are enjoying rises of 1 to 2%. Travel and leisure are up 3%, and banks, which plumbed record lows yesterday, have bounced 1%. Some of the impetus may be coming from oil, where prices are set for their third weekly gain, helped by a rise in Chinese refinery demand. Today's data showing China's industrial output surprising to the upside could also support the thesis that crude demand will rise as economies reopen. China-exposed miners and chip makers are also up. US crude oil inventories have slipped for the first time in 15 weeks, and there is talk of more OPEC output cuts. That's boosted European oil shares 1 to 2%. The backdrop isn't pretty though. Renewed US-China tensions risk strangling any nascent trade recovery. President Donald Trump has declared, in reference to China Xi Jinping, "I don't want to speak to him," and suggested that cutting ties to Beijing could save the United States $500 billion. The effects of that rhetoric rippled across Asia today, sending Japanese shares down for the fourth day in a row and the yuan to one-week lows. The other issue is economic data, and company earnings have been worse than predicted. A Reuters poll of economists now forecast a 35% annualized second quarter contraction for the US economy from 30% previously. Yesterday, data showed almost 3 million Americans claimed unemployment benefits in the week through May the 9th. Essentially, 1 in 5 workers has lost his job since mid-March. In China, industrial production rose more than expected, 3.9% year on year, but there was bad news from retail sales, which dropped 7.5%. Clearly, the loosening of lockdowns hasn't persuaded Chinese consumers to go out and spend. We get advanced readings of Eurozone gross domestic product today, but attention is already focused on the second quarter, where polls suggest 11.3% contraction. Economists have also slashed 2020 forecasts to minus 7.5%. Then there is Brexit. The European Union and Britain wrap up the latest round of negotiations on their future relationship, but British Prime Minister Boris Johnson's spokesman has already said the EU had asked far more from the UK. Before Michael Barnier's press conference, pressure has built on sterling, while sterling dollar volatility has risen above 10% for the first time since the end of April. Company news mostly consists of profit dives and dividend cuts. US first quarter earnings are seen falling by 12.1% from the year-ago quarter versus the 6.3% growth expected on January the 1st. In Europe, there's some morsels of good news. Swiss drug maker Roche will start selling a new digital diagnostics product to simplify and accelerate screening of patients. Finnish utility Fortum beat expectations and planned to stick to its dividend policy. In M&A, the FT reported BT is in talks to sell a multi-billion-pound stake in broadband network operator Openreach, and on the downside, Swiss luxury group Richemont expects headwinds in the months ahead. It reported annual profits down by 2/3. Betting shop William Hill posted a 57% net revenue plunge for the week since lockdowns were imposed in Europe and North America. Eutelsat reported a 4.4% slump in third quarter revenues, hit by postponed sport events and reduced travel. Emerging market stocks are seeing a second week of modest declines, but the Turkish lira is set for its best week since February. It's back below 7 per dollar after a Reuters exclusive that Turkey has reached out to various countries for swap lines. End of article. Bloomberg article dated May 14th, updated on May 15th, that's today, 4:29 p.m. GMT +1. Headline: US stocks drop on trade, data jitters, oil jumps, markets wrap. US stocks fell amid heightened trade jitters and bleak economic data. Oil surged. The S&P 500 extended its weekly slide as retail sales and factory output registered their steepest declines on record. Meanwhile, the US moved to curtail Huawei Technologies' chip supply, driving the Philadelphia Semiconductor Index down by 3%. Energy shares paired this year's tumble as crude traded near a 6-week high. JCPenney soared after saying it made an almost $17 million interest payment due May the 7th. Mounting tension between the world's two largest economies has investors concerned of an even deeper global recession. The cost of the coronavirus pandemic could reach as much as $8.8 trillion, or almost 10% of global gross domestic product, according to the Asian Development Bank. The S&P 500 headed to its worst week since March 20th, or just before the start of a rally of more than 30%. It's a sobering week, said Tracy McMillan, head of Global Asset Allocation Strategy at Wells Fargo Investment Institute. Investors have a lot to think about with regards to China. We got data this week that accentuates the difficulty the economy is experiencing right now. House Speaker Nancy Pelosi is pushing ahead with a vote on a $3 trillion Democrat-only virus relief bill Friday, despite the misgivings of some liberals and moderates in her party, and the fact it has no chance of ever getting signed into law. These are some of the main moves in the markets. Stocks, the S&P 500 dipped 0.7% as of 11:25 a.m. New York time. The Stocks Europe 600 index advanced 0.4%, and the MSCI Asia Pacific index advanced 0.1%. Currencies, the Bloomberg dollar spot index increased 0.3%. The euro climbed 0.1% to $1.08. And the Japanese yen was little changed at 107.23 per dollar. The yield on 10-year treasuries climbed less than 1 basis point to 0.63%, and Germany's 10-year yield climbed 1 basis point to minus 0.54%, and Britain's 10-year yield increased 2 basis points to 0.22%. As far as commodities were concerned, the Bloomberg Commodity Index advanced 0.3%, West Texas Intermediate Crude increased 3.7% to $28.58 a barrel, and gold climbed 0.7% to $1,752.50 an ounce. We'll provide more of an update on gold and silver in a short while. End of article. Bloomberg article dated May 15th, 3:09 p.m. GMT +1. Headline: Gold, silver race higher on fear of second virus wave. Gold jumped to a 3-week high after bleak US government data underscored how hard coronavirus-related shutdowns have hit the world's largest economy. Bullion headed back towards its peak in April, when prices hit the highest since 2012, after US factory production plummeted in April by the most in records back to 1919. And a gauge of US retail sales plunged through the record set just a month earlier. Everybody must have realized it, but it's just more evidence that the reality is this. It's pretty bleak economic picture right now. Phil Streibel, Chief Market Strategist for Blue Line Futures LLC, said by phone, people are continuing to pile into gold because that weak economic picture is going to continue to drive interest rates lower. Gold futures for June delivery traded 0.5% higher at $1,749.90 an ounce as of 9:44 a.m. on the COMEX in New York, after climbing as much as 0.9%. Silver also got a stronger bid, rallying to the highest in 2 months. The two precious metals have been lifted after US Federal Reserve Chairman Jerome Powell warned earlier this week that the pandemic will take a heavy toll on the economy. Fears intensified on gloomy American unemployment data Thursday, and as President Donald Trump said, he doesn't want to talk to his Chinese counterpart right now. Nations that enjoyed success quelling the virus, including South Korea and China, now face a rising number of infections. In the United States, Texas saw its deadliest day and its biggest jump in new cases since the start of the outbreak. That comes 2 weeks after the controversial moves to reopen the state's economy. There are fears over everything from political leadership through the health outlook overall and associated economic, financial and political risk, said Rona O'Connell, head of market analysis for EMEA and Asia at International FC Stone. Prices are having a long-awaited breakout moment as markets' anxiety mounts, she said. End of article. We can see from these reports and from our videos early in the week that gold and silver are going to be the main beneficiaries. And as of 1700 hours GMT +1, this certainly appears to be the case. Gold is currently standing at $1,750 and silver at $16.61. Or in sterling terms, gold is £1,442 and silver is £13.70 an ounce. So a brief look at other market figures. The Dow Jones is now down 152 points at 23,472. The S&P 500 is down 22 points at 2,829. And the Nasdaq is down 56 points at 8,887. Of course, there is still a number of hours trading, and these figures could obviously change before markets close. British and European markets have fared a little better in that the Euro Stoxx 50 is up 0.4%, the FTSE 100 index is up 1%, the DAX index is up 1.2%, and the CAC 40 is up 0.1%, although these figures could alter slightly by the end of the day. Oil prices are up around $1 a barrel, and the dollar index is hovering around 100.4. So whilst we suspect that equity markets may recover a little towards the end of the day, we are quietly confident that with both gold and silver breaking previous resistance barriers, this is now positive for these precious metals moving forward. So do listen out for our update tomorrow. What's your opinion? Do share your thoughts. Meanwhile, thank you for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published, not forgetting to pop over to our Richard and Greg channel, which we updated yesterday. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.